Hey hustlers, my name is Rich Bishop, and I'm the COO of BēST Roofer Marketing, as well as the CEO of Midgame Consulting, where I consult with private equity portfolio companies. And you would ask, why am I here talking to you today? Well, there's been a lot of noise around private equity in the roofing industry. And I know that there are lots of questions and rumors and things just maybe aren't quite clear. So this is a good opportunity for us to talk to you today and help you understand a little bit more about the basics of private equity, what's it all about, and what does it mean for you as a roofer. So today we're going to be talking through a couple of things for you. First, we're going to break down what is private equity and what does it mean? What is it all about? Number two, we're going to be looking at what are they looking for as a PE firm. If you're interested in maybe selling your roofing business to a private equity firm, how do you set yourself up to be in the right kind of spot so that you can get the best offer for your company? The other thing that we're going to talk about is sellers need to be aware, right? There are things that are out there or things that will change as a private equity comes into your business that you need to be aware of. Things that may help make your decision whether you want to sell to them or not. So we'll go through a few of those things to be aware of so that you've got a complete picture of what to expect. We're also going to look at, if you're working to grow your business, maybe some alternatives to private equity. There are other ways to grow your business without having private equity involved, and we'll talk through that. And then last but not least, we'll also be looking at and breaking down the making of Roofing Corp of America, how that came to be, how they ended up growing that business to be a virtually nationwide business and selling it for over $413 million. To see that breakdown and to see the way that they put that together, I think there are some good lessons in there. So we'll break down those pieces for you too. Let's get started. So let's take a look at what a private equity firm is. Private equity, or PE as sometimes it's called, is really just a company that has pooled money from different investors with the purpose of purchasing a company, helping it to grow and improve, and then selling it so that they can make a return on their investment. And those private equity firms will purchase companies, sometimes just one, and help it grow. Sometimes they'll buy multiple companies and pull them together or merge them together in order to make a larger company. But many times what they're going to do is they're going to get into these companies. They're going to help them to implement efficiencies. They're going to look for better processes and doing things more smoothly. They're going to look to cut costs. They're also going to look to add capabilities maybe to a company that already exists that they're looking to add on to. And then, of course, they want to grow the top line, the revenue side of things as well. And this funding comes from these outside investors. They want to make a return better than what they're going to see in the stock market, because anybody could just put their money into the stock market and let it ride, which sometimes is a good investment opportunity for some people. But people in the private equity world are typically dealing with millions and millions of dollars here, sometimes hundreds of millions of dollars that they're looking to employ and to make sure that they can grow. And with that, there is a typical cycle that will last somewhere between 3 and 7 years. And it starts off with a PE firm coming in and looking at different targets. So they may be picking up the phone and actually trying to kick the tires around to see if you're interested in selling, because they've identified that roofing is an area where they want to grow or they want to make a move in the market. And so they're going to look to gauge interest and see what your numbers look like, see if you're interested in selling. So there's a targeting piece of this. The next part is the diligence. And that's when you have expressed interest, they want to come in and really look at the books. So there's probably going to be an NDA, a non-disclosure agreement, that they need to sign, that they'll come in, take a look at your numbers, your accounting books. They're going to ask a lot of questions. They're going to be looking through contracts. But basically, if they're going to invest, they want to know that they've got a full picture of what it is that they're buying. So that's the diligence side of the process. The next piece is actually doing the deal. They're going to make that acquisition, purchase the company, and exchange the funds. Now, one thing to be aware of is in that purchase, many times there's a continuation clause in that. So If, for example, you were to choose to sell your roofing company to a private equity firm, chances are pretty good there are some pretty important people within that company making it tick right now, right? You, for one, I'm sure there are some administrators that are really important for that company on a day-to-day basis. Private equity firm knows that, and they don't want those people to go anywhere. So a lot of the times what will happen is they will actually put a continuation clause in place, or they will put some of the financial aspect of it in place to incentivize you and those other folks that are key to the business to stay for a year or more. And so while you may hear some roofing companies are selling for, let's just say, $5 million, there's a good portion of that money that's tied up for the first year until we get to that 12-month mark. So just be aware of that as you go through and consider whether selling is right for you. So that's the acquisition side. Then the private equity firm moves into action and they look to create value. So this is where they're going to get in there. They're going to put new processes in place. They are going to look to cut costs. They're going to try to drive top line revenue. They may look to make some additional acquisitions to tack on that make sense in order for the company to grow more quickly. And then in the 3 to 7 year mark, they're going to go ahead and look to put that company on the market to sell either to another private equity firm, or in some cases, what we've seen is some of these conglomerates that have been created are being sold to other services firms that are large, maybe national throughout all of North America, in order to get the most value for their money. So what do PE firms look for in a business? Well, first and foremost, they're looking for an opportunity to make money. They want to make sure that they're able to get the most for their money out of the investments that they're making. We said earlier, they want to make sure that they at least beat the market, but they're going for 10x on their money if they can get it, right? They want a higher multiple than what they would see in other places. And so because of that, there is a lot of focus, there is a lot of intensity with the work that they bring at times. So there are two major strategies that private equity firms will employ when they look to make their investments and to grow. The first one is to buy a single company, help it grow through top line increasing sales, or bottom line by cutting costs or gaining efficiencies, right? Making things run more smoothly at a lower cost, and then selling in that 3 to 5 year mark. The other one is to consolidate multiple companies. So grabbing multiple roofing companies throughout the country, pulling them together under one roof, so to speak, and making sure that their administrative costs are down. And if you think about this, it makes a lot of sense. If we were to buy a roofing company in Birmingham, Alabama, and we wanted to build a national presence of roofing companies, well, that company has, I'm sure, financial people, accountants. There's marketing that's involved, even if it's outsourced. There's administrative folks, operational folks. But if I were to buy another roofing company in Atlanta, they have the same functions. Well, maybe I don't need two people doing the same thing. And oftentimes that's what will happen is these private equity firms will come in, buy multiple companies, centralize all of the administrative aspects, hiring, HR pieces of it, the finance side of it, accounting, marketing potentially, operations and dispatching. All of those things could potentially be consolidated to cut costs out of the business, which then drives profitability at the end. And if there's one thing a private equity company is looking for, it's profitability and it's revenue, because that increases what they are able to get when they turn around and sell the company a few years later. So they are looking for, if you wanted to make yourself as a company look attractive, what you want to do is make sure that you've got a growing top line. So you've got growing sales, and there's no better place to learn how to help do that than right here in the Best Hustler Academy. The other way is to cut costs, and that there's an opportunity for them to improve the way that the business is running and the profitability of that business. And then, of course, if you have both things going for you, it's even better. Those are great opportunities for the private equity company to come in, make their changes, and get that investment opportunity there. there are a couple of key business measures that we should also focus on too if we wanted to make our companies look attractive. And the first, of course, is going to be revenue, sales. We want to make sure that we have the right scale of sales out there. If we're a newer company or we have $200,000-$300,000 a year in sales, that's not quite going to be juicy enough for most private equity companies. They're looking for the larger companies that are growing quickly, $5 million, $10 million a year. That's a good spot for them to be able to find value and find opportunity for future growth. The other one is cash flow. We want to make sure that the cash is flowing through the business and running well. What you don't want to do is have a big lag between when the jobs are taking place and when you're collecting on the revenue, with all of the costs happening in between, right? Having the cash flowing freely through that business is going to be critical. And the other one is a term called EBITDA. EBITDA, earnings before interest, taxes, depreciation, and amortization. It's basically your net income before taxes, but that's the number that really drives a lot of the business valuation. So when they're looking to make an acquisition, they want to know that the top line is moving and that revenue is moving, but also that there's profitability there at the end. And those two are the main key markers when looking at the value of a business and putting that valuation in place. All right, so seller beware. If you're interested in selling your business, there are a couple of things that you should be aware of as you look to work with a private equity firm. The first, which we talked about a little bit earlier, is continuity. You're not going to be able to sign a deal and then ride off into the sunset. That's not the way that it's going to work. The way that they look to keep these businesses moving is to have you or other important employees at the company stay in place for at least a year, and they'll tie a lot of the transactional fees or the payouts to happen 12 months after that initial paperwork is signed. So be aware of that, and that you're going to be signing up for at least another 12 months or so, depending on the private equity firm and what their preferences are. The next one is a loss of control. While you will be at that company for another 12 months, you're not necessarily going to be the one to be calling the shots. So while you've grown this business and put your hard work into it, just know that you're going to be answering now to somebody else who is putting these pieces together. So if you are working with a private equity firm and looking to be acquired, those are some areas that you may be able to negotiate a little bit, but in general, that control is going to be given up. The next piece are cultural differences. A lot of what makes these companies strong is that it is the culture that's been built, how people interact and work with each other, the different processes that you have, and how comfortable everybody is. When you do sell to a private equity firm, there are probably going to be some other people that are involved from that private equity group coming in, and there may be a slightly different culture. So if you're a company that prides yourself on the culture that you've created and on the employees that you have, just be aware and really look into, on the private equity side of things, what their culture is and what sort of values that they respect and uphold, and make sure that there's a good alignment there. And then the last one are personnel changes. In almost every case that I've seen outside of the roofing industry, when a private equity firm acquires a company, the financial control is immediately changed. There's almost always a new CFO or almost always a new group of financial folks that are coming in to run the books, because that is where their investment really pays off for them in the long run. They want to make sure that that's controlled. So understand that there may be some personnel changes as well. And also, there may be some of your employees who don't like the change or don't necessarily want to be acquired and like the way that things were and may not react to that acquisition well. So keep that in mind as you look to make that or to become acquired. So if you're looking to grow your company, there are some additional alternatives to private equity that may be a good fit for you. There's a couple of different ways that you could finance your growth. If you have strong marketing and strong sales and you're growing your top line and you're smart about how you're spending your money and you plan it out, you can actually self-fund the growth and have that continue. as time goes on. Maybe it gets to the point where if you have enough of that cash flow and enough of that revenue coming in, that you can actually look to make some acquisitions yourself and tack on, whether it be additional locations or whatever it happens to be able to grow the revenue side of your business. The other one is to potentially merge, finding partners that are out there who are looking to do the same thing, looking to grow, build a stronger company, and maybe there's a good synergy there that you guys can work together and actually create a merger of the two companies. And the other piece, depending on your motivation, maybe you want to step out of the day-to-day running of the business, and that's your motivation for selling. Well, the alternative is to hire or to train folks that are already on your team to run that company without you, to run that business without you. And that you can do just by giving up little bits of responsibility to them over time. Make sure you have somebody that you truly trust. But as you increase your trust in those people, they can get to the point, if you have the right people, to be able to take over that business where you can step out of it entirely and it can run without you. So those are just a couple of ways that you can continue to grow your company without private equity being involved. So let's break down the anatomy of Roofing Corp of America, how it came to be, and how it sold in December of 23 for $413 million. I first want to go to a quote that was written in the press release announcing the sale of Roofing Corp of America to First Service Residential. So Jared Turner, the founder and managing partner of Soundcore Capital Partners, which is the private equity firm that created Roofing Corp of America, said, "We initially invested in this thesis with the goal of creating a leading service provider in the roofing industry. Through a combination of strategic add-on acquisitions, investments in technology and integration, procurement programs, organic growth initiatives, and the addition of several key management team members, we were able to achieve our goals. Under Soundcore's ownership, Roofing Corp's revenue and EBITDA increased more than tenfold." So let's break that statement down here because there's a lot there, but it really is telling about why they created Roofing Corp of America and what it is that they were trying to do. Soundcore Capital Partners said that they were compelled by the level of fragmentation and reoccurring service needs of the roofing industry. And that's why they got into this. So they saw fragmentation, lots of companies that are out there all doing similar things together. And Soundcore said, you know what, we can pull these companies together, create one larger company and create more value out of this. So when you break down the statement that they gave in the press release, they talked about some of the changes that they've made to increase the top line and increase profitability, right? They talked about procurement programs and organic growth initiatives. Those are exactly revenue generating and profit generating type initiatives that they put into place here. And then they did go on to say that their revenue and their EBITDA grew by tenfold. And that is the power that private equity can bring to bringing these multiple companies together and really centralizing some of the administrative work and helping to grow on a broader scale. And we see that here with this. So breaking down the Roofing Corp of America's timeline, it's impressive what they did. And remember, we said it's a 3 to 7 year span, 3 to 5, 3 to 7 year span that these private equity firms will buy and hold these companies before they sell them. It was exactly 3 years that Soundcore Capital Partners had from their first acquisition to selling it for $413 million. That's a lot of money. And they're not in this just for the single transaction or the one company at $4 million or $5 million. They were in it for $400 million. That's a big number. So when we look at the timeline, Roofing Corp of America was created in December of 2020 when they acquired the original roofing company in Nevada. They waited about 7 months or so before their next acquisition, where they purchased Innovative Roofing Group of Georgia and Bone Dry Roofing, also in Georgia. So you could see they started in Nevada, went over to Georgia, and we can see a little bit of work starting to go in the southeast here. In April of 22, they bought Davco Roofing and Sheet Metal of North Carolina. In July of 22, they purchased AAA Roofing, which operated in California and Idaho. In August of 22, they purchased Deer Park Roofing of Ohio and Kentucky. In October of 22, they purchased Pittman Waller in Georgia. And in December of 22, they finished the year by purchasing Weather Shield Roofing and Sheet Metal in Texas. That's 5 acquisitions in 22 alone. And then in 2023, they purchased Front Range Roofing in Colorado and Wyoming. In December of 23, right before they sold the company, they purchased Roofing Technologies, Inc. out of Louisiana. And then in December of 23, they sold for $413 million, all of those. And if you look, they had purchased 10 roofing companies in that time frame. And let's just say that the average sales price of those companies was $10 million. Okay, so they put maybe $100 million, if those numbers are correct, into the acquisition to turn around and sell it for $400. That's a really good return on their investment. And if we go back to the statement that was made, they had improved their revenue and their profitability by tenfold. That's where the money's made in the private equity industry. And that's why these groups are knocking on your door and calling you. And you are in a great position to take advantage of it if you choose to.